Hello, everyone, especially Facebook viewers, and welcome to Municipal Bond Investing During a Pandemic. We have a special guest today, Mr. Micah Potashnik here from MacroView Investments LLC. Very excited to have him. And at this point, I'm going to go ahead and invite some of the folks that have been waiting to get into this particular Zoominar. But we are so happy to do these Zoominars for not only our clients, but also the public, just inviting people that we would normally interact with, network with, share some of our own clients with at the Jason Howell Company who are just experts in their field. And we just believe that that's what people should be looking for when they are bringing a team of advisors to take care of their family, experts in every part of their financial life. So just by way of casual introduction, I just want to say, hey, Micah, how are you? How's your day been?
Doing well, Jason. Day's been going well. Looking forward to hitting the driving range after this.
Hitting the driving range. You must be in maybe the golf capital of the country. Where are you?
Yeah, I'm actually just outside Hilton Head right now in South Carolina, visiting some family. So enjoying the hot sun, and fortunately we have a nice, warm, humid day out here. Social distancing, of course, but driving range is open, so certainly take advantage of it.
Well, sounds like a great time. I'm sure you won't be wearing a button-down collar out there with the driving range, but get a few tips for me. I'm not so good at the old driving range. I'd like to be better for sure. Yeah, well, just so everyone knows, we have folks who are coming in every once in a while, so you will hear a ding now and again. Of course, there are folks on Facebook who are just joining in too. But if you have a question and you are with us on this Zoominar, feel free to go into the chat and submit your question at some point. I promise I will read your question and get it to Micah. If not, I will send an email and get it to Micah and maybe connect you to, which would be just as cool, I'm sure. So yeah, get ready for a good show. Okay, I'm going to transition to our PowerPoint slides so we can get this show on the road. All right, and here we go. A little preview, I guess, of where we are. So if you came to Municipal Bond Investing During a Pandemic, you've come to the right show. Welcome, everyone, both from Facebook and the Zoominar and, gosh, around the world, as it were. We've got Micah Potashnik, who is a well-qualified financial advisor, amongst many other things, to tell us a little bit about municipal bonds and, gosh, just bonds in general. So that's going to be a great Q&A. Once again, if you've got questions, please put them in the chat and I will share them with Micah. And now a word from our sponsor. So all of these Zoominars are sponsored by my firm, Jason Howell Company. We are a family wealth management firm that specializes in creating matriarchs and patriarchs out of Gen X and millennial families. We do this by equipping them with 3 tools. One of them is a roadmap, which highlights what they need to do, so the normal recommendations you might get in a financial plan. Another is an implementation guide, which really shows them how to prioritize all of those recommendations that we typically put together, anywhere from 40 to 60 recommendations. And the final tool we equip our parents with is what we call a family constitution. This is really different and unique to our firm. It's the how and why. It's the values that the families have that they want to pass down to the next generation. It's really the whys, so it's the stories that they've had from their past. And it really just puts together this nice package of saying, here's the what, here's the when, and here's the how and why, so that everyone really understands this isn't about money as much as it is about life. We call this process family governance, and for more about that, just go to jasonhowell.com. Okay, and now on to our show. So Micah Potashnik from MacroView Investment Management LLC. This is a great firm founded in 2010. Similar to our firm, it's a registered investment advisory firm. They've got a handful of great advisors. And what you might see, especially exhibited by this Zoominar, is sometimes we advisors, even though we might be in different companies, work together and share expertise so that we can do the best things we can for the communities that we serve. They're based out of Bethesda, Maryland. As I mentioned, this firm was founded back in 2010 by Mr. Daniel Cohen. Initially, they were focused on fixed income investing, which is probably why Micah is such an expert in this area. So we are so happy to have him. As you can see from this little blurb here, Micah has a mathematical background. He'll talk about his major, went to American University, though he had this really, pretty special interest in math as it's speaking to. He is a charter retirement planning counselor, which is a designation he had to earn to really specialize in the retirement field, and also an accredited investment fiduciary, which typically, and Micah, correct me if I'm wrong, this really helps if you're specializing in managing 401ks and some of those employer-sponsored plans.
Yeah, absolutely.
That's terrific. We'll love the fact that you're an AU grad, mostly because I teach now at AU as an adjunct professor, and some of that, what you attended, right? You attended a personal finance general ed course, and you said it was pretty impactful to you.
Yeah, absolutely. It was actually just a general education class offered to all students, and it was sort of one of my first tastes in just learning about what's an IRA, what's a 401k, stocks and bonds, cash flow planning, the power of compounding interest, all of which are topics that I think are very valuable for anyone, not just in the field of finance, but for anyone that is heading off into the real world. And Jason, it's great that you're now teaching that class. And between you and me, I actually think it should be a requirement for all undergraduates to take this personal finance class. So it's and something, as I continue in my field, helping former classmates and colleagues that are rising up in the ranks in their professions, and helping them start to get their finances in order.
So great. And you've taken that education, and I guess all 8 years of your career you've spent at MacroView. So Dan Cohen and his team must be doing something right. But like you mentioned to me, give us a little color here. You said if you weren't doing this, you would be a math teacher. Talk about that.
Yeah. So, at American University, I was a mathematics and economics major. So, math is my, first love, and, that plays right into, fixed income and bonds, which are very, math oriented. And, I've always enjoyed teaching and helping others learn, which is, part of the reasons why, I love being an investment advisor, because, as investment advisor and dealing with other people's finances, it's important to teach and educate and make sure, they know what, is going on with their money. And, over the years, people have just sort of turned to me to assist them when it came to math. And I think math's one of those topics that, is not always taught in the best way. Each individual has their own way of learning, especially when it comes to math. So I've always been passionate about, making sure everyone around me has that same knowledge base, and hopefully at one point in life, down the road, maybe a math teacher's in my future. So it's certainly something that I've always thought would be a great sort of second career down the road, and so we'll see where that ends up.
No, well, thanks, Micah. I'm sure there are many high school professors or principals out there saying, "What? You're interested in helping our kids? Please come on down." That'll be terrific. You will find opportunities not only later in the road, but as early as today. In fact, there might be some math tutoring opportunities that people are looking for now during the pandemic. I'm just so glad you're here. I think we met just a few years ago, but we've stayed in touch. I know you're working now with some of our clients in helping identify fixed income opportunities. And to that point, we're going to really just get an idea of why this might be an area that people should explore. So much of what we hear about investing happens to be in the equity market, the stock market. Is the Dow up or down? Is the S&P 500 up or down? And not enough focus, I'm sure you might agree, is placed on the debt markets, the bond markets, and how that might affect your portfolio. So let's just start off with the most basic of questions. Micah, what exactly are bonds?
Yeah. So a bond is a fixed income instrument that represents a loan made by an investor, myself, a client, whoever it may be, an investor to a borrower. It could be a corporation, a municipality, the U.S. government. And you're lending your money to that borrower, and with that, they are promising to pay you a stated rate of return on that money. And that's called a coupon payment. So they said, I'm lending my money to a borrower. The borrower is going to pay me a stated interest rate over time, and at some point later in the future, called a maturity date, you're going to get your principal payment back. And along the way, you get a fixed income stream, hence the term fixed income. And as you said, Jason, why equity markets are sort of the sexy, make a lot of returns. There's obviously a lot of volatility and risk in equity markets, as we've seen here in the last few months during this pandemic. So complementing your portfolio with fixed income really helps sort of smooth out that return over time, and helps limit losses, and is a really powerful financial planning tool, knowing that that fixed income stream is always going to be there for you.
Got it. And I guess you kind of answer that second question too, which is why invest in bonds, at all. Maybe I'll make a little bit more of a detailed question out of that. Would you suggest investing in bond instruments directly, or do you think that some of the bond funds are also great investments, or can it be either depending on your situation?
Yeah. So again, when investing in bonds, kind of to take a step back, for us, as I kind of alluded to, the reason why you own the bond are really for three main reasons. It's to preserve capital, while maximizing a return, and provide that income stream, and complement the riskier portion of an investment portfolio. And so for us, at MacroView, it's sort of a decision tree. First establishing why own bonds in the first place. What role does it play in a portfolio? And then from there, you need to figure out how do I want to own my bonds? And there are two ways you can own bonds. You can own bonds via a bond mutual fund or bond ETF or exchange traded funds, where your money is pooled with other individuals' money, and there's a advisor out there, a portfolio manager that invests those dollars into many different bonds. And you can look at your account and see how the aggregate of the bonds perform on a day-to-day basis. Or you can invest in individual bonds directly, where in your account, you own that particular bond. That bond is yours, it belongs to you, and you have the option of buying and selling that individual bond at any time. So it's really a difference between a vehicle that you can buy and sell and the individual bond itself. And at MacroView, we are big believers in individual bonds. And the reason that's the case is, as I said, with bonds, there's a stated maturity date, that date in the future where you are getting your principal payment back. With a bond ETF and mutual fund, there are no maturity dates. There is no date in the future that you're getting your principal investment back. So when the bond market moves up or down, interest rates move up or down, and your bond fund fluctuates in value, and let's say it moves down in price, you don't know when you're going to get that $100 back, or that principal investment. With an individual bond, that date in the future you're getting that money back. And that's why it's such a powerful financial planning tool, and also powerful from a portfolio perspective, where if you have any short-term losses or declines in the bond itself, over time that money's coming back to you. And so that's why we believe so strongly when investing in bonds to own individual bonds.
So it sounds like what you're saying, you could invest in bond funds if you like, and those could be exchange traded funds or mutual funds, but they're kind of a different animal than the actual bond that you might invest in, where you're really investing in a debt. You're going to get that money back. In between, you might get some interest payments, and it can be as simple as that, versus the funds, which could fluctuate a little differently, and you may not quite know when you're going to get your money back, and you may not get the exact amount back.
Exactly. It's that customization element that is so crucial for us when it comes to bonds. And when you do own a bond ETF or mutual fund, you technically own hundreds and hundreds of different underlying bonds. That's what makes up the fund itself. You just can't see those bonds on a day-to-day basis. You can't see how each bond is trading, nor can you trade a specific bonds. What we do for our clients is, we go the other way of buying, individual bonds. And that allows us, when you have fluctuations in the marketplace, to take advantage of different opportunities out there to, buy bonds that are cheap, or, that offer more yield than maybe a current bond in your portfolio. There are many different things we can do to help increase the return in the fixed income portion of the portfolio that unfortunately many mutual funds and ETFs just are unable to do.
That's going to take a little expertise, though, to just buy direct bonds. I mean, it's not as easy as opening a Vanguard account and clicking a button.
Yeah, so that's fortunately why we exist. As you said, Jason, we manage for individuals and help manage their fixed incomes, both for high net worth individuals, retail investors, but also with I know we'll dive a little bit more into this later with other investment advisors who maybe don't have the time or resources to spend the time to look at the bond market, to look at for those opportunities, to do the credit research, whatever it may be. When it comes to bonds, ETFs and mutual funds are a great tool in the fact that you're able to, kind of give someone else let them go, manage those dollars, but you don't have that control. And so, we have both the control and the ability to, customize and, take advantage of those opportunities. And that's why we believe so strongly that when it comes to bonds, having individual bonds and having advisor who understands the bond market is really important in these times where interest rates are very, very low. The 10-year treasury is yielding less than 0.75%. You have corporate bonds that are being downgraded left and right. And so having someone out there that can do the research, can understand the totality of the market and look to find where the best value occurs in our minds, is what allows your fixed income to be fixed income.
No, terrific. Having someone who would have who was a math major and has a lot of interest in that area helps too. Well, tell us, Micah, how has the COVID-19 pandemic really changed the bond market, if at all?
Yeah. So this kind of seems like again, COVID started just a few months ago, but it certainly feels like it's been a few years here, and there's been trials and tribulations within the bond markets, and for the first few weeks when COVID hit and the market sold off, stock market sold off, most bonds provided that ballast, that complement to the riskier portion of your portfolio. And then come middle of March, we had a period of time where there was sort of a max exodus to cash, where everyone out there was going to cash. There was a lot of uncertainty out there, and people were sort of indiscriminately selling anything in their portfolio to get the cash, whether it's to cover margin calls, whether it's I just don't want to lose any more, whatever the reason may be. They just wanted to go to cash, and that's where it comes back to. I'm going to keep on using the term active management, because that's where active management is so important in bond world, because when this indiscriminate selling occurs and the JP Morgans of the world are having to sell bonds out there because individuals are redeeming shares of their mutual funds, well, those bonds are being forced to sell at a cheaper price than what they probably are truly worth. And so, what we do then is we, look to take advantage of that and see, well, wow, these bonds are really, really good bonds for a variety of reasons, but they're just trading really cheap because, someone needed to go sell it, kind of diamonds in the rough, or, bonds falling out of trucks, whatever the terminology, you call it. And so, we're able to, again, take advantage of those times when there's a lot of fluctuations in this COVID world of buying bonds at yields that are significantly higher than, comparison, bonds out there. We were able to buy some bonds that were trading, up to like 8 times a treasury bonds. So, here we are buying bonds that are very, very high in credit quality, very good, stable balance sheets, yet trading at 8 times the value as a treasury bond. It's kind of a no-brainer. And so, during these times, it's even more important than ever to have someone that can take advantage of that, those opportunities.
Oh, it's terrific. Thank you for sharing that. What you're highlighting is, as an active bond trader, you can really take advantage of what we all sometimes forget, that it's a market. And in a market, there are buyers and sellers, and you guys can be either, because that's just what you do.
Exactly. That's a great way to put it.
Tell us a little bit about municipal bonds. It's a phrase that people hear and they kind of cringe a little bit. It sounds very fancy, and then it sounds maybe a boring fancy in a kind of a weird way.
Yeah.
What's good about them?
Yeah. So, Municipal bonds, again, are bonds that are sold by state and local governments that are used to fund day-to-day obligations and to finance public projects such as building roads or schools. So when you go and own a municipal bond, you're really owning one of two types of municipal bonds. There are general obligation bonds, which are bonds backed by the full faith and credit of a specific municipality. For example, the state of Maryland or the Commonwealth of Virginia might issue, bonds. They're looking to, borrow some money to, for their, day-to-day obligations, and they issue debts, and you as a bondholder are paid back that debt due to the fact that it's the state of Maryland and the Commonwealth of Virginia that they're going to have funds available to pay you back. So that's kind of one type of bonds. The other type of bonds are called revenue bonds. And as the name sounds, those bonds are backed by a specific revenue source. Maybe it's income from a toll road or revenue from a hospital. And so a lot of the bond buying that we do for our clients are actually revenue bonds. And specifically, a certain type of revenue bonds called essential service revenue bonds. And these are bonds that are backed by, for example, water and sewer revenue, which makes them better protected from economic downturns, since people will always have a utility bill to pay. No matter what of the economic conditions out there, people are still running water, using sewers, whatever it may be, and they have a utility bill to pay. And there's actually a great case study back in 2013 when the city of Detroit defaulted, huge default, and the Detroit individuals who owned Detroit water and sewer bonds actually were paid back 100% of their original investments. So even though the city itself defaulted and the people that owned Detroit city bonds, lost some of their money and didn't get all their money back, people that owned the water bonds actually got 100% of their money back. And so that's just sort of a great example of why the bond you own and understanding the source of the revenue is very important. Because again, Detroit maybe has a current and negative connotation, but their water and sewer bonds were good to go during a massive default.
Okay, so what I'm hearing you say is a municipal bond is a municipality, city, state, locality. They want to borrow money, assumedly from their citizens, but they could be borrowing it from anywhere around the world. The folks who have extra money to invest, instead of putting their money in the stock market, they're going to maybe buy these bonds. And MacroView specializes in revenue bonds, not only revenue bonds, but essential service revenue bonds, which is to say, like a water utility, where people are paying bills. These are other people. These are not investors. They're paying bills. Those bill pays are used to essentially pay that money back. But I guess the city or state didn't have the initial amount of money to, say, fix the pipes at the beginning of the day. So they needed to borrow a chunk from investors. They could build the pipes and then they pay it back through the citizens who are paying their water bill.
Exactly. It's exactly how revenue bonds work. And in this case, when it came to Detroit, people were still paying their water and sewer bills. So everything was good to go from a bondholder's perspective.
So we know some municipal bonds are different because you mentioned essential service revenue bonds. Are there other kinds of municipal bonds, going to that question about that have different risk and return, qualifications or characteristics?
Yeah. So, obviously, the example, the, general obligation versus the revenue bond is one way where, you have two bonds, both from the same city, but have different revenue backings, offer different, risk rewards. But, as you said, when most people think of municipal bonds, they think of the fact that the interest that you receive on that bond, that fixed income, that cash flow you receive on a twice a year basis is exempt from federal taxes. That's one of the advantages of municipal bonds. It's a way to get some income and not have to pay taxes on it. It's pretty great setup. There's also a part of the municipal market that is a little bit lesser known, but is still quite large. It's $500 billion and growing. And that are what are called taxable municipal bonds. And these taxable municipal bonds don't carry that tax exemption. The income you receive would be subject to federal income taxes. But in order to entice an investor to buy a taxable municipal bond, you need to be offered something in addition, or else you would never buy it over the exempt product. So these taxable municipal bonds often offer significantly higher yields than their tax exempt counterparts. And one of the things that make taxable municipal bonds so great is take an IRA account, an individual retirement account, where the money in those accounts grow tax deferred until you take the money out from a distribution. Well, usually IRA accounts and municipal bonds don't really go together. Why buy a bond that is income tax exempt when already the money in my IRA account is growing tax exempt? That wouldn't make any sense. That's inefficient. Well, now take taxable municipal bonds, which offer higher yield than both a tax exempt municipal bonds, offer higher yields than a corporate bond, offer higher yields than a treasury bonds, but are still very, very high in credit quality. Now you can go put those in an IRA account, and now you can get access to municipal bonds when you never could before. So it's a great tool to use in those types of accounts. And as people start to retire, roll over 401ks, get closer to retirement, and fixed income becomes a higher allocation in their overall balance sheets. Municipal bonds are a great way taxable municipal bonds, I should say, are a great way to get some fixed income exposure.
Got it. So taxable municipal bonds can give you that higher interest rate because you're not getting the tax advantage. Ends up being pretty competitive because it's higher than a federal bond, or even or maybe matches some of the high stable corporate bonds. I guess you could always get a higher yielding corporate bond, but you take on more risk. Whereas I guess a municipal bond that's taxable can give you a high return, even though the risk is fairly low.
Yeah, so actually, if you look at the taxable municipal market right now compared to the corporate markets, and if we just focus on what we call investment grade bonds, so bonds of the highest quality, and for those that look at bonds and their credit ratings, are triple B all the way up to triple A. That's the range of what are called investment grade, and those are bonds that are the most stable, are have the best balance sheets, are the ones the rating agencies are most confident that you're going to get paid your interest and principal over time, which is obviously going back to why you own fixed income. You own fixed income for that cash flow, and you want to make sure that cash flow is going to be there. And so right now, taxable municipal bonds actually yield more than comparable corporate bonds of the same credit quality. So we have a couple examples that we'll show on PowerPoints comparing for example, a Home Depot bond that has a maturity date of 5 or 6 years out, and a taxable municipal bond with a similar maturity dates. And that taxable municipal bond yields anywhere between 50 to 100 basis points, or call it 1% more every single year than the comparable corporate bonds. So for us, even if you're choosing between a corporate bond and a taxable municipal bond, it's actually really a no-brainer for us that taxable municipal bonds yield significantly more than comparable corporates across everywhere in the investment grade sphere. Now, if you start getting into high yield and more risky corporate bonds, that dynamic can change. But now you're starting to take a little bit more credit risk. And for us, it no longer becomes fixed income. It becomes more of an equity product, since it's more highly correlated to equity. So again, taxable munis, taxable corporate bonds, taxable munis win on a yield perspective, and they win on a credit perspective.
Got it. Yeah, I mean, you could have high risk bonds called high yield, right? Risk and return go together. You learned that in your principles class, right? But that's not what MacroView specializes in, and it's not typically what people are looking for with bonds. They're usually looking for some stability in their portfolio, and you folks look at really the most stable area of bonds and see, hey, maybe I can get some more return than I should be even getting, but I can lock it in by investing in these particular kinds of bonds that just so happen to have a high yield.
Yeah, exactly. Going back to sort of that decision tree, starting at the top of why own bonds, then you choose individual bonds over bond funds, and then you got to pick, within the bond space, in the landscape of bonds, what types of bonds do I want to own? And, again, we kind of go through, treasury bonds that, don't yield a lot, corporate bonds that, yield, a decent amount, but carry a lot of credit risk. Then you have municipal bonds that, default, on average, 23 times less than corporate bonds. So from a credit standpoint, it's a no-brainer that municipal bonds are a better credit. And then you start working the yield component, and the yield's higher. And so again, if you have, risk on one side and reward on another side, and you graph it and try to find what is the optimal place to invest in, the choice is municipal bonds.
Oh, terrific. Oh, we've got one more question on the list, and the timing is working out just enough. I'm sure people, if they've been on the whole time, they might be a little overwhelmed. So give us a little bit of an idea of how you work with other financial advisors, financial planners, and I guess why you do that as a firm.
Yeah, we'll start sort of with the why, because I think that's a good starting point. And for us, obviously, we're very passionate about bonds, and we're passionate about the role they play in a diversified portfolio, and they play that important role. And so everyone, regardless of your age, should at least have a some allocation to bonds. And as you get older, that allocation becomes higher and higher. And we just very strongly believe in individual bonds. And as we've been talking about, it's hard for an individual investor or even advisors to go invest in individual bonds. There's a lot of research that goes in. It's a lot of time. It becomes a full-time job to do it. And so you kind of need to hire someone that's their full-time job to analyze the bond space and find the best bonds out there. And so we wanted to take that expertise out to the world, not just with individuals, but to other investment advisors who have their own clients that maybe were unable to get the exposure that is most appropriate for their clients. And that's kind of what we do, is we work with those advisors and say, instead of you buying a bond mutual fund or bond ETF that charges its own fee, that it's not customizable, that your client doesn't really know what they own, work with us at a competitive rate, competitive price. But now the client gets the individual bonds, can see on their statements the cash flow that's coming in, can see the bonds they own, can take advantage of those opportunities that we've been talking about, where bonds are cheap to the market, things like that. All those reasons of ways to maximize that return on bonds can be done, and we would like to take that out to as many people as possible and give them that access that maybe they're unable to get with their current situation. So I don't know if that answers the question or not, but that's sort of why we started working with other advisors is kind of going back to that teaching element that we talked about at the beginning, and my background and my passion. It's teaching and helping others, and when it comes to being a fiduciary, doing what's best for your clients, we want to make sure that everyone out there has access to the same product. And so that's what we've been able to do. And we've been doing this, as you said, since we started in 2010. We now have our own portfolios that we have, performance that has been audited. So our numbers are all been, legitimized by, other, sources out there. And, the numbers, are pretty good. And we've definitely, done better than our benchmarks, things like that. So the numbers speak for themselves, but also, I think the peace of mind that we're able to give both advisors and individuals is really what's most important.
Yeah, and like you said, there's a cost to it, but it's competitive, because otherwise, advisors like myself all across the country, if they're using mutual funds or exchange traded funds to invest their clients, there are fees for those funds that essentially will be eradicated, getting rid of, and then a fee comes to you guys. And it might be a little higher, but the expertise you're getting is very different.
Yeah, exactly. And so when it comes to mutual funds, so again, we've been talking about this active management. Most ETFs don't provide active management. Most ETFs, exchange traded funds, tend to track an index. They track an index, and as the index takes in bonds and sells bonds, that's what they do. Active management, which is really kind of more of a mutual fund thing, and what mutual fund portfolio managers do, those funds tend to charge 60, 70, 80 basis points, which is again, it's probably a fair rate for the expertise you get, but it's not cheap. And so we come in significantly below that, because for us, again, obviously we need to get paid, but it's not about charging the most as possible, or maximizing the fees we get. It's about, doing right by the clients and getting them that access that, either might be too expensive for them or, might be hard to get otherwise.
Well, I know as a fellow financial advisor, it's been wonderful to have you and the other players in your firm as a resource for our clients to get that expertise. And it's still significantly different than just working with a fund and hoping that that portfolio manager who manages the actual fund does right by you. Having a conversation makes all the difference. Well, thank you, Micah. Thank you for sharing just some of your expertise that you bring from MacroView. For all those who are watching, I'm going to stop the share, so brace yourself. Big faces are coming. Here we are. We're back. I think we've had a great discussion about really not only how municipal bonds, but how bonds in general can play a part in your portfolio beyond just the stocks of the world, and how you can sort of bifurcate that between corporate bonds, federal bonds, municipal bonds, and taxable municipal versus non-taxable, and the extra risk and return you may or may not be taking on. So just a great presentation. Thank you so much, Micah.
Oh, thank you so much for having me. I really appreciate it.
Well, before you go, and I always ask this question just in case there was something at the the tip of your tongue here. Is there one thing that we should walk away from in this conversation, maybe that's actionable, that we can do as people who have our own portfolios in regards to bonds?
I think the most important thing is to understand what you own. Take a look at your portfolio. See what bonds you own, see what types of bonds you own, and maybe there's a way that you can get better return on those that allocation by maybe taking some less risk. And so we are always happy to review portfolios, take a look at it for you, and give you our 2 cents of ways that we could go and improve it. And I always think that's a good starting point. So we're not expecting you to go make this analysis, but we love the opportunity to take a look to see what you're doing in the fixed income space and seeing if there's a way for us to help you out.
Micah Potashnick, Chartered Retirement Planning Counselor, accredited investment fiduciary, golfer. Thank you so much for spending some of your away time with us today. We look forward to hearing more from you, and for all those who logged into this, I will send an email out with Micah's information, and if I do this right, clean up this video and you'll have it forever. Okay, everyone, enjoy the rest of your day. Micah, thanks again so much.
Thank you.
Take care.